What's up, everybody? It is Devin here. I have something super concerning for you guys. The Federal Reserve Bank of New York reported that there is $18 trillion worth of consumer debt. Trillion with a T. That is insane. That is so much debt that America is in, and that is keeping people in poverty, basically. There's really no middle class anymore. It's the super wealthy, and then there's the poor. So what we're going to go over today is how to get out of that debt. This is something you guys have asked me a ton about, which is a practical way of using the infinite banking concept. And you can use the concept to pay debts off so much faster. You don't have to pay anything extra, not one penny extra. All you have to do is change where your money goes first and then pay the debts off, and they'll get paid off so much quicker. So in this video, I'm going to show you guys how to do it. If you have not subscribed to my channel, make sure you do that. It really helps the channel out. Hit the bell so you get notified when I put out these videos, and make sure to throw comments in the comment section. I will make sure to respond to all of them to show my appreciation. So guys, let's jump into it and show how to get out of $18 trillion worth of debt. Crazy. All right, guys, this is a real life example. One of our clients who was in all of this debt that you see behind me, almost $500,000 worth of debt. We showed him how to get it paid off so much quicker, changing one thing, which is where his money goes first, and then paying the debts off. So check this out, guys. We've got almost $500,000 worth of debt here that we're going to be paying off. Now, this comes out to almost $6,000 a month. That's $70,000 a year that was leaving this guy's pocket, and it was leaving his family really forever. Once the money's gone, he can never get it back, and the money can never make him money ever again. So that much was actually leaving. If he simply took his savings, which this is what most people think to do. They think, take my savings and pay my debt off faster. If he did that, it would take him 19 years to get out of all this debt. He was saving about $25,000 a year. So he thought, let me take that savings, let me pay the debts off faster. 19 years is how long it would take. Check out how fast we got him out of debt by simply changing one thing. So what he's going to do, he's going to take his $25,000 in savings. Instead of paying the debt off first, he's going to put it into his very own infinite banking policy, which is a high cash value whole life insurance policy with a mutually owned company. Super simple. So he puts in $25,000. He's immediately got access to about $15,000. So what he's going to do, he's going to actually take the $15,000 and pay off Discover and pay off Lowe's. So those two debts are gone now. He was paying 21% on Discover and 11% on Lowe's. $161 a month on Discover, $287 a month on Lowe's. He was paying them every single month without fail. So all he's going to do, he's going to simply mimic what the bank does and recapture that money, okay? So very simple. He was paying between these two debts $448 a month. So all he's going to do is take that $448 and pay it back to his policy because he leveraged his $15,000 out of his policy. So he's just simply going to take that and flow it back to his policy, $448. So that comes out to, as you guys can see, about $5,300. So the next year, year two, he's going to put his savings, his $25,000 in the policy. Immediately, he's going to have access to over $16,000. Every single year within these policies, because of the compound interest, he's always going to have access to more than he had the year before. So $16,500 plus what he was paying himself back, he's got almost $22,000 now. So he's going to take that $22,000 and he's going to pay off Nordstrom's, Wells Fargo, his private loan, and he's going to pay down some of his BMW. All of these debts, again, same thing. He was paying them every single month without fail. He's simply just going to control who's getting that money now. And the interest, guys, 3% to Nordstrom's, 21% to Wells Fargo, 10% to the private loan. He's now got $1,917 that he's recapturing. He used to be losing it to the banks. He's now getting it back every single month. So what's going to happen now? Year three, he's going to deposit his savings again into his policy, $25,000. Now look how much he has access to. Almost $26,000. Puts in 25, has access to more. That's the beauty of these policies. There's a efficiency point. Usually it's around year 3 or 4 where you put $1 in and you can use more than $1. And every single year, that difference in how much more you can use to what you put in goes up. It's crazy. So he was recapturing all this money, remember, throughout the year. So $23,000 that he used to pay on all these debts that he paid off, he's now recapturing it. So together with his cash value, he's got $48,000 and some change. So what he's going to do, he's going to pay off his BMW, he's going to pay off his boat, he's going to pay down his condo. Now he's got even more money that he can recapture, almost $4,000 a month, plus the interest he was paying on those things. So that payment, $36.77 that he used to pay, that includes interest. He was losing that every single month. He's just keeping it now. He's retaining it. He's recycling it and recapturing it back into his banking system. So here's the thing about this, guys. This is a marathon. It's not a sprint. So I want to go over one thing with you guys. 25,000, 25,000, and 25,000 is how much he used. So he used 75 grand, right? Or how much he's put in. He's put in about 75 grand. He used 14, 16, and 25. So he used about 55. How much does he have left in the policy? Most people would think he's only got 20 grand left. He actually has all 75 grand still. He hasn't used this money. He's just borrowed against it. He's borrowed from the insurance company's money. His money is held as collateral. So his money keeps compounding and growing tax-free. So this year, this is year 4, puts his savings into the policy. Policy's cash value goes up by $26,300. He's been recapturing this money, $44,000. So he's got 70 grand. He can't pay off the condo right now. This is a marathon, again, not a sprint. So $26,000 is what he has left on his condo. Nothing changes this year. He can't recapture more money. So a year is going to go by where he's just recapturing the same amount. Year 5 comes, puts his savings into the policy. Again, cash value goes up. He's got $44,000 that he's been recapturing all year. So he's got $71,000. He's going to pay off the condo. He's going to pay down the house. Now he can recapture that $879 that he was losing on the condo. He's now recapturing $4,500 that he used to give away to the banks. So year 6 comes around, and here's kind of a not confusing part about policies, but it's something that we just have to abide by to stay within the tax code. You can only put so much into a policy until it becomes taxable. So with his policy, for the first 5 years or whatnot, he could put in 25 grand, no taxation. After that, he could only put in 10. If he starts putting in more, he gets taxed. So very simple. He's going to put in 10. That gives him access to $13,000 right away. That's crazy. If you could go to your bank and put in 10 grand and instantly have access to 13, you'd keep putting 10 grand in your bank. Now, he's just going to simply start another policy. That's how you get around the tax portion of this, is you max out one, and then you just start another, okay? So he's going to start another. He's got access to about 15 in this second policy. In the first one, he's got access to 13. So he's going to take those two, that's about 27, plus the money he was recapturing. He has about 83 grand now, okay? So this money is, again, cash value from his first policy for putting in 10 and cash value from the second policy for putting in 25, plus this money that he was recapturing. He's not doing anything else but just controlling who was getting his money. Before, all these companies were getting it. Now, he's keeping it. So he's got 83 grand. That's enough to pay off the house, okay? So the house is gone. Think about that, guys. He's paid off his debt. Instead of in 19 years, he's paid it off in 6. He didn't pay a penny extra. He just simply took his savings that he was going to use to pay off his debt and simply put it into a policy first and then paid off the debt. Very, very simple. Now, anyone can do this. It works very, very easy. And, it doesn't matter how much debt you're in, how little, how much, it works with anything. It's all about getting started. That's the key point. So there you have it, a super easy and practical way to use the infinite banking concept. And you're not having to pay anything extra on debts. You're simply changing where your money goes first. That is it. As you could see, this guy, all he did is he took his savings, the 25 grand, and put it into his policy first, and then he paid off his debt. He did that every single year, and he got the debt paid off in a fraction of the time. You can do the exact same thing. If you guys want to learn more about this, there's a couple things. First, ask some questions. Put your questions in the comments, and I will make sure to answer all of them. The second thing is in the description of this video, there is a link to register for a full training on how this works. You'll get more examples on this. You'll actually get how to buy cars, how the whole concept works from start to finish. You'll understand it a lot more from watching that video. At the end, you can schedule a call with someone on my team. We'll make sure to answer all your questions. And if you want to get a policy, we can set you up. We don't charge a penny for the call. We don't charge a penny to set you up with a policy. We simply make sure it's done correctly. And then once you do the policy, the insurance company pays us for bringing them business. So it's been a pleasure, guys. Until the next one, this is Devin, Mr. Burr, signing out. Love you guys. Peace.